So well done for getting this far. We're going to now move on to speaking about futures, the futures market, and futures contract. So we're going to start with what is the futures market, what is a futures contract, types of futures contracts, and what is traded in the futures market. So, what is the futures market? The futures market is where people buy and sell contracts to trade assets such as gold, crude oil, and stocks indices. Indices is instead of looking at one company, a stock index tracks many companies together. Today, that will be bought or sold at a future date. A futures contract. A futures contract is a single binding agreement made today to buy or sell something at a fixed price in the future, where profit or loss depends on how the market price changes. So these are the things that you need to know. One, it's an agreement, not a purchase yet. You're not buying the thing that you're trading now, you're agreeing today for later. Two, the price is fixed now, the price is locked in. Market price changes don't affect the agreed price. Three, it's binding, you can't just walk away. Both sides must honor the deal. Four, prices moving means a profit or loss. If price goes your way, you profit. If price goes against you, you lose. So sell and buy. So there's two sides. One is a buyer. You're buying in hopes that the price will continue to go up. You're placing longs, and you benefit if the price goes up. If the price goes down, if the price is going down, you see that the trade is going down. You are placing a sell, which is also known as a short, and you will obviously profit if the market continues to go down. One simple mental model, you are locking in a price today and taking a risk on where the market will go. So we're going to look at the difference between a futures contract and the futures market. A futures contract is the agreement, and the futures market is where those agreements are traded. So a futures contract is one single agreement. There's one buyer, there's one seller. There's fixed terms in terms of price and date. So the contract has an expiration date. Then there's the futures market, which is the market as a whole trading system. Many buyers and sellers, prices constantly changing. So we're going to be using analogies for you to understand the futures market. So let's just imagine you've gone to a carpet shop, you've got a new flat or a new house, or you want to upgrade the carpet you already have. You go to the carpet shop and you agree today to buy a carpet in 3 months for £500. Both you and the shop are committed to that price no matter what happens to prices later. So if the price goes up and down, it doesn't matter. You have locked in the price for £500. So if the price of the carpet goes up, the seller can't tell you to pay more, and he just simply loses out if the price of that carpet goes up. You both commit to the deal. You leave some money as a guarantee, but you can't just walk away. The agreement is binding. It's like agreeing with the shop today to buy something later at a fixed price, and both sides must stick to that deal regardless of whether the price goes up or down. So the carpet is the asset. So think of like in the stock market, as a futures trader, you'll be trading oil or gold. The £500 is the agreed futures price. The 3 months is the future delivery date. Think of the can't walk away as the binding contract. So even if you don't want the carpet, you still have to pay for it. It's set in stone. It's a binding contract. So in the futures market, you don't put down a deposit to lock in purchase like in a shop. Instead, you put down margin, which is not a fee, not something you lose by default. It's just collateral to ensure you can honor the contract. Think of it in this way: futures is a binding contract. You're putting down like a collateral, and it's not a fee. This is something you have to pay for regardless of whether the price goes up or down. So we're going to move on to the plane ticket analogy. Let's say a travel agent working for a large travel company agrees today to secure a set number of flight tickets for a group traveling to New York at Christmas at a fixed price. Both the airline and the travel agency must honor the price. Both the airline and the travel agent must honor that price, even if ticket prices go up or down. Even if the price is less than what the travel agent bought, they both have to honor the price. So there'll be no refunds from the airline, and the travel agent won't have to ask the group to pay more if the price goes up or down. Even if the price goes up or down, the airline can't ask the travel agent to pay more or less. That is the fixed price. That's just the price that's set in stone. Both the airline and the travel agent has locked in a binding contract that both of them have to honor, and they cannot come out of that binding contract to ask anybody for more. The group still gets to travel to New York, whether the price goes up or down at the price that they already paid. So let's say you're a fashion designer and you go to your manufacturer and you agree to buy fabric in bulk from a factory at a fixed price for delivery in the future for your summer collection. Both sides must honor that price regardless of whether the market price goes up or down. Fixed price, which is the futures price, and the delivery date is the contract date. So whenever the contract expires, they both take this risk. If the fabric gets cheaper, the designer loses out on like a discount or a cheaper price. If fabric gets more expensive, the factory loses on the price difference. But regardless of whether the price goes up or down, or who loses or who wins, they both have agreed on the price and they have to honor the price. In futures, you're buying contracts, and once you enter, it's a binding contract. When you buy a gold futures contract at a fixed price, you'll make a profit if the market price rises above that price, and a loss if it falls below. A trader agrees to buy gold in 2 months at a fixed price. They profit if the market price rises above that agreed price. So, there's different types of future contracts, and that's what we're going to go over from here. The futures market trades futures contracts on assets like commodities, financial instruments, and indices. So, we're going to go over this step by step. Commodities is a basic raw material or product the world uses every day that is interchangeable with others of the same type. When we think of the word interchangeable, that's one unit which is exactly the same as another. For example, 1 ounce of gold is the same as any other ounce of gold. 1 barrel of oil is the same as another barrel, same grade. What commodities are not is a house, artwork, designer clothes. These are not interchangeable. So, as we said, commodities are things that we use every day. So, think of metals like gold, silver, and copper. There's energy such as crude oil, natural gas, and petrol. So, commodities that are central to the world. Oil is used for fuel, wheat is used to produce food, metals for electronics. Why commodities are traded in futures? One, prices fluctuate a lot. Commodity prices change consistently because of weather, which affects crops, supply issues such as oil shortages, shipping delays, and so forth. Demand also changes. For example, the price of oil today might be £70, but next month it could be £90 or £50. This is a problem because this creates uncertainty. Businesses want price certainty. Businesses use futures to protect themselves from price changes, such as airlines, they want to be in control of fuel costs. Farmers, they want to be in control of selling crops. Food companies, buying raw materials. Import and export companies, they want to be in charge of the import or export charges. And banks and financial institutions, they want to protect their customers' investment portfolio. And such as retailers and large companies, they want to make sure that the products and their stock that they're buying, the prices don't fluctuate. So just think of it in this way: you're locking in price today using futures. So businesses are use the futures market to lock in price today. Today they know the costs. So think of it in this way: businesses use the futures market to lock in price today, so they don't have to worry about how it will affect their businesses later. So many types of business that use the futures market for multiple different reasons. So as you can see, there's a range of different pictures. So we're just going to talk about different industries. So let's start with farmers. Farmers who are selling crops such as wheat and corn. Prices might fail before the harvest. They use futures to lock in price today. Food companies, such as grocery stores, etc., um, who rely on their basic stocks such as sugar and coffee. They use the futures market to lock in price to avoid price spikes. Manufacturers use materials like steel and copper and oil to control production costs. Import and export companies deal with foreign currencies. They use the futures market to lock in exchange rates. Banks and financial institutions that are affected by interest rates use futures to protect against rate changes. Retailers and large companies buy goods in bulk, often globally. They use the futures market to stabilize costs and pricing. Airlines need large amounts of fuel. Fuel prices change a lot, so they use futures market to lock in fuel prices. So, this is where you come in. As a futures trader, you will be making profit from prices going up and down. Let's say, for example, you are trading crude oil. Let's say today the price is £70 and you put in a buy, as you can see that the price is going up. Let's say the price rises to £90, you then make a profit of £20. However, let's say you see that the price is £70 and you think it's going to go up, but the price dips and it falls to £50, you will lose £20. Traders take on risk to make profit. Businesses use futures to protect themselves from price changes. Futures exist because businesses want certainty and others are willing to take risk. Commodities are traded in futures because price change a lot, so businesses use futures to reduce risk, while traders use them to profit from those price changes. We're going to move on now to stock index futures. You're probably wondering, what is stock index futures? A stock index is a group of stocks representing a market. Stock index futures are contracts based on the future value of a whole stock market index. So you might have heard of the S&P 500, which tracks 500 large US companies, the FTSE 100, which tracks 100 largest UK companies, and the Nasdaq. Instead of tracking one company, you track the whole market under one of these indexes. You can't physically buy an index, it's just a number. Futures let you trade the value of that number. So let's look at the US stock market indices. So you might have heard of these already. So there's the Dow Jones Industrial Average. It tracks 30 large, well known US companies. Think more established companies such as Apple, Microsoft, Coca-Cola, and McDonald's. There's the S&P 500, and that tracks 500 large US companies, much broader than Dow Jones, considered the best overall measure of the US market, such as the Nvidia, Netflix, Chase, and that's just to name a few. The Nasdaq includes many technology companies, very technology focused, such as Apple and Microsoft, and it's considered to be more volatile. Prices move quite often and quite fast. This is a good overview of the indices that are available to trade on the stock market, and futures lets you trade on whether those markets will go up or down. So just have a look and just to familiarize yourself on what they are. So we have it by region, index, and what it represents. So let's get more familiar with what these indexes are. So we've already spoke about some of these already. So we're going to speak a bit more in detail. So what is the FTSE? So it's a group of stock market indices representing different parts of the UK market. Stock index futures are contracts where you bet on whether a whole stock market will rise or fall in the future. So let's say, for example, the current FTSE 100 is at 7,500. You buy a futures contract at 7,500 for 2 months. The outcome is the market goes up and it goes up to about 300, and as the market goes up, you profit. You take a profit on that. If it goes down, for example, let's say it goes down to 7,200, you lose. As you entered at 7,500 and you was betting that it was going to go up. There's different types of FTCEs. We have FTCE 100, FTCE 250, FTCE 350, and the FTCE All Share Index. They all represent the amount of companies that are listed under them. So FTSE 100 is the 100 largest companies, FTSE is 250 companies, FTSE is 350 companies, which has a broader view of the large to mid companies. FTSE All Share Index, almost all UK listed companies, represents 98% of the UK market. Best overall picture of the UK stock market. Okay, so let's move on to the Nasdaq. What is the Nasdaq? The Nasdaq is a US stock market index that includes many technology and growth focused companies. The Nasdaq includes over 3,000 companies, making it much broader than most other major indices. Why the Nasdaq moves the most is because it's very tech company focused that grow fast but also fall fast also. Think of it this way: the Nasdaq is the future focused tech world. So let's discuss the difference between commodity futures and Nasdaq futures. Commodity futures protect physical goods that is used every single day, whereas the Nasdaq futures protects a portfolio value, companies as a whole. The Nasdaq itself doesn't use futures, but traders and investors use the Nasdaq futures to speculate on or hedge, which is to protect yourself against the risk of price changes or to avoid losing money if something changes in the future, against movement in the overall stock market. So protecting yourself against the risk of price changes or to avoid losing money. So this is kind of like the Nasdaq as a whole. Like it is, we already spoke about it already. It's the massive tech world. So think of big tech leaders such as Apple or Microsoft, and Meta, Nvidia, Google. Let's think of companies that are focused on AI chips and software, um, such as ASML, Applied Materials. The list goes on. Let's also think of healthcare and biotech. These are companies that are also listed on the stock market, for the futures market. There's also tech and growth companies such as Tesla, Netflix, Adobe, Intel, AMD. These are big growing tech companies. Let's also think of consumer and services. They are also a part of the Nasdaq, such as Starbucks. There's a Starbucks on every corner. PepsiCo, Costco, and Airbnb and eBay. This is just a brief overview of the Nasdaq, but this is just a way for you to just get a gist of when we say it's a tech focus index. This is some of the companies that is listed under it. Okay, so well done for getting this far. We're going to move on to the S&P 500. So Nasdaq futures are used to hedge or trade tech-focused companies, while the S&P 500 are used to hedge or trade the overall market. Nasdaq futures are used to hedge or trade tech-focused companies, while S&P 500 futures are used to hedge or trade the overall market. Both Nasdaq and the S&P 500 futures are used by investors and traders, but Nasdaq focuses on tech companies while the S&P 500 represents the broader economy. The main difference is what part of the market you're exposed to, tech companies versus the whole economy. So let's move on to currency futures. So I'm sure you've seen some of these currency exchanges before, such as the US dollar versus the Great British Pound, the euro versus the US dollar. We're going to be speaking about what are currency futures. So currency futures are contracts where you agree today on an exchange rate between two currencies for a future date. So I'm going to say that again. So currency futures are contracts where you agree today on an exchange rate between two currencies for a future date. Currencies are always traded in pairs: the US dollar versus the Great British Pound, the euro versus the US dollar. The price is the exchange rate. For example, $1 is 80p in Great British Pounds. So clearly there's a 20p or 20 cents difference. How currency futures work: you agree today to exchange currencies later at a fixed rate. You don't exchange money now, you agree on the rate for the future. So let's look at the US dollar. So let's say that today 1 USD is equivalent to 80p. And then um let's say that that's the exchange rate you bought at. The US dollar starts to strengthen, you place a buy, the US dollar is now equivalent to 90 pence, which is in Great British pounds or pence. Now, the one US dollar is equivalent to 90p, so it has gone up, the US dollar has strengthened, so you would have made a profit on that move. Let's say the US dollar isn't doing as well, um, and you say, okay, I'm gonna enter in a buy position, but it price drops, and now the US dollar is now worth the equivalent of 70p. Um, you must still pay the 80p, but the market rate is now cheaper, which is now 70p. So then this is where you would lose a bit on the trade. So you're probably thinking, who uses currency futures? How does currency futures work? So let's start with businesses. Businesses that deal with foreign currencies use futures to protect against exchange rate changes. So let's say a UK company importing from the US needs to pay in USD in 3 months. The problem is the exchange rate might change. So the solution would be to lock in the rate today using futures. This gives certainty. Let's also move on to traders now. Traders place trades based on speculation. Traders use currency futures to make money from exchange rate movement. So they bet on whether a currency will strengthen or weaken, place a buy trade where they expect the currency to strengthen, or they'll place a sell because they expect the currency to weaken. Financial institutions use the futures market to also lock in price. So let's start with banks. Banks lend money in different currencies and they handle international payments and they hold foreign assets. The problem is the exchange rate might change and it's constantly changing. Let's say a bank expects to receive 100 million in 3 months in US dollars. If the US dollar weakens, they receive less in Great British pounds. And there is a big difference between the US dollar and the Great British pound. They are expecting such a large amount. So the solution here is use currency futures to lock in the exchange rate. Now they know exactly how much they will receive and risk is reduced. So there's companies that invest globally and they take large positions in different markets. They are called hedge funds. For example, they might invest in US assets. They measure returns in Great British pounds. If the USD fails, profits disappear. Currency exposure using futures protects profits, reduce risk from currency movements. So let's move on to investment firms. Investment firms manage money for their clients. Investment firms manage pensions. They rely on currency movement. Currencies moving up and down affects their clients' portfolio value. UK fund invest in US stocks. Let's say the US dollar fails. Remember, they are managing their client's portfolio. The investments that they are managing loses its value, even if stocks rises. So they use the futures market to protect clients' returns and stabilize portfolio value, as their main job is to protect their clients' pension funds. So they heavily rely on futures market to protect their clients' um, money. Well, that was the futures market and futures contract explained. In the next class, it will be explaining contracts in more detail. We'll be speaking about different contracts that can be traded on the stock market, and we're going to be talking about micro, mini contracts, and full contracts, um, and how to pick contracts, where to pick contracts, and yeah, we're going to be talking about contracts in more detail. Well done for getting this far. Let's move on to the next one.